Welcome to vTalkInsight, Market Drivers Daily for August 13th, 2026. The market narrative right now is being pulled in three directions at once: an AI financing boom, stubborn geopolitical risk and energy, and surprisingly resilient global growth. How those forces resolve will matter for credit spreads, inflation paths, and where equity leadership sits into year-end. Let's start with the AI cycle and what the latest funding trends are telling us. The AI story has shifted from pure equity upside to the question of how an enormous build-out is being financed and what that means for risk pricing. Over the last couple of sessions, we've been highlighting growing scrutiny of AI credit, and today that shows up clearly in primary markets. Roughly 60% of this year's very large corporate bond deals, those above $10 billion, are coming from tech names. Crucially, that supply is mostly funding AI infrastructure rather than classic mergers and acquisitions, and it is starting to cause real indigestion. Investors are demanding bigger concessions to absorb the risk, pointing to an emerging premium for AI-linked credit exposure. That pressure is reinforced by forecasts that overall corporate issuance could surge by about 65% year-on-year, with AI-related borrowers a major driver. Hyperscalers are now issuing long-dated bonds at a scale that rivals large U.S. banks in terms of duration risk, and some funding is shifting into off-balance sheet structures. NVIDIA is reportedly exploring up to $500 billion of external financing for AI infrastructure, even offering computing power itself as collateral. At the same time, there is rising use of residual value guarantees in AI hardware financing, which look vulnerable if a cheaper Chinese model or a new architecture suddenly undercuts existing kit. With some high-growth AI names trading at 50 to 100 times sales and hardware and optical stocks already doubling or tripling, the bar for future performance is uncomfortably high. Against that, the underlying demand picture still looks powerful. AI training and inference costs per token are falling sharply, with new models reportedly as much as 80% cheaper than rivals, which helps broaden enterprise adoption even if it compresses margins for some incumbents. Large companies are consolidating legacy software tools into AI platforms and building custom applications, while data center networking orders from hyperscalers are growing at triple-digit rates. Lenovo has more than doubled revenue in its AI infrastructure segment. Memory suppliers expect tight markets for the next 6 to 8 quarters, and firms like SK Hynix are committing record sums to high-bandwidth memory capacity. Yet converting that demand into near-term earnings remains uneven. Cisco, for example, now expects AI to account for only about 10% of revenue next year, disappointing investors who extrapolated stronger growth from its order book, and hardware names such as Cerberus are finding that big orders are often recognized with long lags. Markets are punishing any result that fails to clear very elevated expectations. Leadership within the theme is also rotating. Some investors are trimming crowded megacap positions and looking instead at infrastructure, industrials, and utilities that benefit from data center buildouts, as well as smaller companies in the AI materials and substrate supply chain. AI adoption remains concentrated in a relatively small group of firms, but the combination of cheaper models and strong tax incentives on capital expenditure is expected to spread margin gains more broadly, including to small caps. At the same time, skepticism is rising about how transformative today's large language models really are, and about business models built on open-source models that may signal competitive weakness rather than strength. Public and policy pushback is another constraint. Surveys show most young adults now want tighter oversight of AI and even a slowdown in data center construction, while senior figures at companies like Alphabet are talking openly about an international AI safety body. That suggests additional regulatory friction around permitting, energy use, and model governance could build from here. Despite these tensions, capital remains keen to fund clear monetization stories. Anthropic is preparing a potentially record-breaking IPO, coupled with the planned acquisition of Descartes, to boost chip efficiency and alleviate compute bottlenecks. And private market valuations for fast-growing AI application developers remain very rich. Investors appear to be prioritizing visible revenue backlogs and infrastructure execution over abstract valuation concerns in the near term. But the macro backdrop is still one of scarcity, in both energy and AI capacity, which keeps inflation pressures alive even as AI promises future productivity gains and eventual disinflation through efficiency and Chinese overcapacity. From here, credit spreads on AI issuers, the reception to upcoming AI IPOs, and any tightening in regulations around data centers or model safety look like the key signposts. Those signals will also feed directly into our next topic because the AI build-out is colliding with already strained energy and geopolitical fault lines. Geopolitics and energy remain tightly intertwined, and the disconnect between short-term price action and underlying risk looks increasingly striking. Brent crude has just pulled back by around 2% after a 6-day rally, hovering in the high 80s, as markets react to Washington signaling a shift from military escalation to more economic pressure on Iran. That cooling in prices sits uneasily alongside persistent tensions in and around the Strait of Hormuz. Iran is exerting de facto control by threatening shipping, even while officially claiming openness, and the International Energy Agency still sees a significant supply shortfall in the order of almost 2 million barrels per day. The result is an embedded geopolitical premium that can reprice quickly on any new headline. The more acute stress is in refined products and logistics rather than crude itself. Global diesel and other refined inventories are being drawn down rapidly due to refinery outages in Russia and the Middle East and export restrictions from China, leaving the United States as the main swing supplier. Europe is particularly exposed. Diesel demand, there is softening under the weight of high prices, but stocks remain low. Gas storage is only in the low 40s as a percentage of capacity. And this week alone, European natural gas prices jumped by about 9% on heat waves, low nuclear output, and water shortages. Those same climate stresses are disrupting inland logistics, with record low water levels on the Rhine, threatening industrial production and commodity flows. Meanwhile, disruptions in the Middle East are pushing up global freight rates, helping container lines like Maersk and regional peers to raise guidance, but also feeding back into broader inflation through shipping and fuel costs. This energy backdrop is central to the rate story. Long-dated U.S. Treasury yields remain elevated, driven by a mix of inflation expectations, fiscal deficits, and geopolitical risk, and upcoming auctions will test how much duration investors are willing to absorb at these levels. In the U.S., headline inflation risks stay elevated because of oil and fuel, even as core measures and wage growth have been moderating. A former Federal Reserve official has even argued that some of the recent hikes might not have been delivered without the earlier oil spike linked to geopolitics, underscoring how tightly policy is now bound to energy. The UK offers a similar tension. Energy prices are expected to push headline inflation up toward just under 3% by year-end, largely through household bills, even as core reaches its lowest level since 2021. The Bank of England is widely expected to stay on hold for now, effectively allowing markets to do the tightening, but a renewed jump in oil or gas could force a policy rethink. The strategic backdrop in the Middle East remains unsettled. U.S. efforts have shifted towards sanctions, blockades, and targeted strikes, but past experience suggests these measures have struggled to shift Iranian behavior, and Tehran has recently elevated hardliners and reorganized its military for a more aggressive posture. Iran's economy is under severe strain, with a collapsing currency, hyperinflation, and rolling blackouts, yet the regime has so far proved resilient. At the same time, U.S. and allied stockpiles of key interceptors like Patriot and THAAD have reportedly fallen by roughly 2/3, and replenishing them will take years, fueling strong order books and cost pressures across the defense industrial base. In Europe, a separate set of political risks is emerging around migration. Frictions between Italy and Spain over surging arrivals, an untested new EU migration pact, and deep divisions among member states all raise questions about the bloc's capacity for cohesive crisis management. None of this is an immediate market shock, but it does argue for a persistent geopolitical risk premium, especially in European assets. There are, however, important offsetting forces. More crude appears to be reaching the market than many third-party trackers suggested, with producers like ADNOC raising output and China actively using its strategic reserves and import timing to act as a swing buyer and stabilizer. Saudi Arabia and the UAE are also investing heavily in alternative infrastructure to bypass Hormuz, while governments have been releasing reserves and tweaking regulations, such as U.S. efforts to soften gasoline standards, even if the scope for further price relief looks limited. Global oil demand growth in developed markets is dampened by efficiency gains and electrification, but the destruction of refining capacity and low inventories mean any new supply shock could still trigger severe price volatility and even demand rationing. Key watch points now include negotiations around reopening Hormuz, European winter preparation, gas storage data, and defense and energy policy decisions, all of which will frame the macro backdrop for the growth picture we turn to next. Global growth data continue to surprise on the upside, but the strength is concentrated in a relatively narrow set of themes: AI infrastructure, trade linked to electrification, and security and defense. Earlier this week, we noted how AI and resilience-related capex had become the main engine of the expansion. The latest trade and earnings signals broadly confirm that picture. At the same time, the macro backdrop is far from benign. Energy and component bottlenecks are keeping inflation above target, even as many forecasts now see U.S. growth slowing into a range between roughly 0.5% and 2% over the coming quarters. That combination of solid but moderating growth alongside supply-driven price pressure is a key lens for interpreting asset moves. The clearest evidence of momentum is in global trade and shipping. Container volumes are rising rapidly, especially for products tied to electrification and data infrastructure, and are now growing faster than port capacity additions have done since the financial crisis. Far East export growth accelerated to nearly 6% year-on-year in the second quarter, and major container lines expect global volumes to rise by about 4 to 5% this year. Maersk has raised its full-year outlook for the second time in 7 weeks, and peers like MK and Mercer are also upgrading guidance, citing resilient Asian demand and higher freight rates driven by Middle East disruptions. Data center capacity is scaling in parallel. Despite more delays and cancellations as pipelines expand, stranded capacity has stayed broadly stable at around 11%, suggesting demand is keeping up with new supply. That is consistent with the strong AI infrastructure orders discussed earlier and reinforces the idea of a multi-year investment cycle rather than a short burst. Domestic data in key economies add to that picture of resilience. In the UK, second quarter GDP grew by about 0.4%, beating expectations, with services and warm weather supporting retail and tourism, and surveys indicate the positive momentum likely extended into July. There are doubts about how durable that pace is, given one-off factors like major sporting events and typical patterns of growth fading in the second half of the year. But for now, the UK looks to be experiencing a soft landing, albeit with renewed energy price risks into the winter. In the U.S., corporate earnings growth remains strong. The Russell 3000 is seeing some of the fastest profit expansion since 2021. S&P 500 small-cap indices are near record highs, and many management teams attribute margin gains more to operational efficiency and AI-driven productivity than to pricing power. That points to an expansion that is increasingly capex and productivity-led rather than purely demand-led. Beneath those headlines, however, the expansion is uneven. Sectors linked to AI, infrastructure, defense, and select consumer brands are performing well, with examples ranging from wind turbine makers seeing orders up more than 50% on data center demand, to retailers and restaurant chains reporting improving trends. By contrast, areas tied to housing, autos, and lower-income consumers remain sluggish, and private equity flows are tilting toward tangible, less tech-exposed businesses, partly out of caution about AI disruption and valuations. On the macro side, capacity and supply constraints in both energy and AI components are keeping inflation uncomfortably high even as growth is expected to slow, and some semiconductor subsectors remain highly concentrated duopolies, which can amplify pricing power and cyclicality. The industry itself expects memory capex to accelerate into next year and stay elevated for several years, supporting the cycle but also delaying the point at which free cash flow returns meaningfully. From here, the sustainability of this growth phase will hinge on whether AI-driven productivity gains start to spill over into lagging sectors, and whether energy and logistics bottlenecks ease rather than tighten. Freight rate volatility, upcoming GDP and inflation prints, and fresh guidance from capital spending-heavy companies will be important markers for how long the current expansion can run without a sharper policy or market correction. To wrap up, the picture today is of an AI cycle that is still driving powerful demand and earnings, but now increasingly financed through heavy bond issuance and complex credit structures that are starting to command a risk premium. At the same time, geopolitical tensions, especially around the Strait of Hormuz, are keeping an energy risk premium embedded in inflation and yields, even as spot oil prices wobble on shifting headlines. Global growth indicators from container shipping to UK and US data continue to beat expectations, but the strength is narrow and depends heavily on AI infrastructure, defense, and energy-sensitive sectors. How credit markets absorb ongoing AI and sovereign supply, how winter energy risks evolve, and whether productivity gains broaden out will be key for cross-asset pricing into year-end. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.